I've been seeing this meme a lot on the internet, especially on Twitter, whenever you buy the dip, but it just keeps dipping. I'm sure a lot of dividend investors can relate, or maybe any investors that's invested outside of the Magnificent Seven. You have all kind of stocks, the pharmaceuticals, even Pfizer is going down so much, even utility companies like NEE, which is Next Era Energy. This is some kind of a clean energy utility company. And people say you should own utilities because they are safe. Well, the utility companies are trading like, some kind of shit coins. And if you look at NEE, it's sitting at $52 where it was trading at in 2019. Any stocks that's dividend oriented, even stocks like McDonald's is down like 7% on the month. I mean, this is rare for a company like McDonald's. You have companies like Coca-Cola and utility companies. So it's been very, very ugly for dividend investors, especially for REIT investors. You have something like Realty Income, which I'm pretty interested in. It's down around 23%. You have triple net. But a lot of you have asked me to review ADC, which is Agree Realty Corporation. It's down 23%. Now, the reason why ADC is extremely interesting is because it has massive insiders transactions. The insiders have been loading up on shares for months. Since May, pretty much, they have been buying a lot of stock, $1 million, 500,000, 1.7 million, 600,000, 700,000, 300,000. They have been loading up. The directors, the officer, and even the CEO bought 500,000, not too long ago, pretty much last week, around $56 per share. They have been buying pretty much every single dip, which makes ADC extremely interesting. ADC is sitting at $53, much lower than any insiders transactions they have been buying since the $65 range. And the latest one was 56, and now ADC is sitting at $53.86 at its March 2020, pretty close to its March 2020 lows, and where it was trading at around 2018, which is one of the reasons why I'm extremely interested in REITs, especially Mid-America and Realty Income. Now, ADC, I have to admit, is an extremely interesting one. But the main reason, we have whatever is happening with REITs and the dividend stocks is the federal funds rate is sitting, at a pretty high level of 5.25, but you also have now the 10-year and the 30-year treasuries. They have started to go up. I personally believe they will likely top around 5%, maybe maximum 5.25. So we're pretty close to a bottom on the dividend stocks and REITs, in my opinion. We're closer to a bottom than a top. This is how I think about it. The 30-year is getting pretty close to 5%. I don't see it going to 6%. I think 5% is somewhat of a fair number on the 30-year, which could potentially means that we're getting pretty close. But if you have at least a 5-year horizon, history would tell us that the Fed hikes interest rates like what happened in 2004, 2005. They aggressively hike interest rates and they hold them for a few years and then they cut. Now, and the same thing happened in 2000. Now, if you have a few years and maybe, the Fed's going to hold them for a year or two. But after a year or two, those dividend yields that you believe are not attractive, 6 and 7 or 8%, they're going to be extremely attractive whenever we go back to something like 2 or 3% interest rate, which is a neutral rate from the Fed. This is imminent. It feels like it's impossible. It feels like we're going to be at 5% forever, but we're not going to be at 5% forever. Maybe for a year or two, maybe 3 years. But eventually we're going back down. This is just the way it is. And even though it feels like it's going to be like that forever, it most likely won't, which is why I'm interested in REITs. I'm going to review ADC. ADC is extremely, extremely interesting in terms of the tenants, the high quality tenants that they have. The largest tenant base is with the Walmart stores, 6.5%, pretty safe. Dollar General, not the best, 4.9%. I really love their exposure to auto parts store, like O'Reilly's Auto Parts is 3%. AutoZone is 1.5%. This is high quality stuff. Sherwin-Williams, pretty safe. 2.1%. Wawa gas stations, Home Depot, Lowe's. This is pretty amazing tenant base. In my opinion, it's a little bit better than what Realty Income actually has. I love the exposure to something like the auto parts store like AutoZone and O'Reilly's. I think it's something pretty amazing within the company. They also have been doing a lot of disposals and a lot of low performing stuff, lower quality stuff. They're trying to get into longer term leases, more recession proof stuff. For example, they dumped a lot of the Mattress Firm stores in 2021, 2022. This is an extremely smart move. They dumped some Walgreens, Hobby Lobby. Camping World, which is not performing well. Realty Income has exposure to Camping World. in my opinion, the company is in big trouble. The camping world, I'm saying. But yes, I mean, they did pretty amazing in disposing a lot of lower quality, less recession-proof assets and getting more into higher quality, more recession-proof kind of assets, which is pretty amazing. Now, the best part about ADC and the reason why ADC is trading at a premium to something like Realty Income. Even though Realty Income is a much larger company, ADC is trading higher. The main reason ADC is trading higher is because they have a fortress balance sheet, and I agree with the company when I said a fortress balance sheet. I mean, they pretty much have no debt due before 2027. Pretty much no debt. I mean, pretty amazing. And then in 2028, they have 410 million. But from now till 2028, I mean, it's secured at a lower interest rate, but maybe they can refinance some of it whenever rates are lower, likely lower by 2027. But from now till 2027, the debt situation is pretty amazing. Now, Realty Income does have a lot of debt maturing, I believe, in 2025 or 2026. But again, it has a fortress balance sheet in terms of ADC, pretty amazing stuff. Now, it has a fortress balance sheet for good reasons. This is because of the massive share dilution. It's a little bit higher than Realty Income's dilution, in my opinion. I mean, that's what REITs do. They had 22 million shares in 2016. Now their shares are pretty close to 80 million. This is a massive, massive share dilution. But normally, whenever you see such share dilution, you have to look at per share metrics. You have to look at EPS per share, free cash flow per share, not just look at the, at the net income. The net income is maybe up 30 to 50% every single year. But you have to look at net income per share, EPS per share, free cash flow per share, or FFO per share. Now, in this case, if we look at the adjusted, which is AFFO per share, the company has been massively growing AFFO despite them diluting stock, which means they created a positive net value for the company. It's pretty high, higher than Realty Income. Realty Income is normally 3 to 4%. You have something like ADC growing. It's a much smaller company, a few $1 billion market cap. It's growing much, much higher, around 6%, 9%, 7%, 4%, 3% is expected in 2023. That's pretty amazing in my opinion. 6 to 7% is pretty, good in terms of FFO growth per share, which is very, very important whenever you're looking at REITs. Now, if we look at the dividend yield that ADC is offering, it's around 5.3%, one of the highest over the last 5 years. Now, if we compare it to Realty Income, Realty Income's dividend is higher than ADC. ADC's dividend is around 5.2%. Realty Income is around 6%, which is amazing. I personally prefer a REIT, some kind of a REIT with a 6% dividend because of the yield I can get buying something else. I want something higher than the treasuries. I think 6% over is an amazing yield, but the main reason ADC's yield is lower is because ADC has a better balance sheet in the short term and ADC has higher AFFO per share. It's a much smaller company, so the acquisitions are going to be more effective for ADC than they are for something like Realty Income. Now, if we look at the dividend itself, they also have been growing the dividend faster. It's a monthly dividend payer, but ADC has been growing 6% over the last 10 years, which is aligned with their FFO growth of 6%. Realty Income has been around 3.5 to 4%, but this is, again, pretty amazing for ADC, over a 6% dividend growth. Now, in terms of the valuation on the company, it's getting pretty undervalued. It's now trading at 13.7 FFO per share. This is lower than the March 2020 low, and it's pretty close to what it was in 2016 when the company was much smaller. They didn't have the scale that they have. They didn't have those things they did. They had a lot of debt problems in 2016. Now the company has better management. There's a much better company, but it's sitting, well below the March 2020 lows in terms of the multiple. This is the kind of bad sentiment that REITs have, which is why I'm extremely interested, even though I'm looking wrong for a while. But I know a few years from now, or maybe a few months from now, we're going to look back at those opportunities and we're going to be glad that maybe we were a little bit of contrarians or we took advantage of buying something when it's not easy to buy. I always say that the best time to buy something is when it's not easy to buy. The worst time to buy something is when it's easy to buy. For example, in 2021, you had the rally, you had Tesla going up, everything is going up. It was easy to buy because you would make money. It was easy, but it was the worst decision you could have ever made, because a lot of you that bought the 2021 peak maybe are still down 50% till today, even after the recovery and the correction that we had. So the best time to buy is when it's not easy, like in March 2020. These stocks are making new lows every single day. You don't know when it's going to end. A lot of the REITs are experiencing something like March 2020. They just keep making new lows. They keep making new lows. When is it going to end? We don't know when it's going to end. Normally, this is the best time to be buying, when it's not easy to buy, when most people are not buying. But at 13.7 is an extremely attractive multiple, but it's still more expensive than Realty Income. Realty Income is trading around 12 times AFFO per share, price to AFFO. In terms of ADC, is 13.7. It's much, much higher. Now, to me, I would expect the same kind of return from O and ADC, or maybe ADC is a little bit higher. I would expect on average a 6% AFFO growth per share. I would expect a 5% dividend, which is around an 11% return outside of any multiple expansion. For me, ADC is extremely interesting, but I'm not interested in the company, as I'm looking for a little bit of a higher yield. Now, if ADC gets to a 6% yield, which would be around $51 or a little bit below $51 per share, I would be extremely interested in potentially maybe owning something like ADC, because it's much smaller, it has much higher growth potential than Realty Income, but I would need to buy it at least a 6% dividend, so I can at least collect some kind of yield while I wait for the market to, prove me right eventually, which I know I'm going to be right. I just don't know when, which is why it's normally the best thing to do is to buy in dollar cost average, not go all in such situations when you just never know when it's going to end. So I would be extremely interested whenever ADC gets to a 6% dividend yield. I mean, now it's not bad at all. I think it's a high quality growth, REIT company, pretty amazing stuff. So this was my thoughts on ADC. So thank you for watching the video. I really hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.